So in just the first 90 days of 2026, Alphabet dropped $35.7 billion on physical servers and data centers.
Yeah, just a staggering amount of cash.
Right. I mean, if you annualize that run rate, you are looking at capital expenditures that could literally buy entire Fortune 500 companies outright, like in cash, every single year.
It's completely unprecedented for a private entity.
Exactly. And yet, while they were spending more money on physical infrastructure than anyone in the history of modern commerce, their profit margins didn't, collapse. They actually went up.
Which is, frankly, the ultimate contradiction here. I mean, in traditional corporate finance, when you initiate a massive infrastructure build-out, your margins are supposed to compress, right?
Right, because you're taking on all that debt and depreciation.
Exactly. You deal with integration costs, you sacrifice short-term profitability to position yourself for the long term. But Alphabet just reported a quarter where they defied that gravity entirely.
And that is exactly what we are tearing apart today. For you, the listener, whether you are managing your own portfolio or maybe analyzing tech trends or just trying to understand the macroeconomic forces shaping the market, we are going to find out exactly how Alphabet pulled off the most expensive magic trick in corporate history.
Yeah, we really need to look under the hood on this one.
We do. We are putting on our Talk Tickers hats today for this deep dive. Cool. We're going to strip out all that Wall Street jargon and look straight at the raw data from Alphabet's massive Q1 2026 earnings call.
Because the numbers tell the real story here.
They always do. We're going to break down the mechanical reality of how their technology generates these numbers and deliver a data-forward, opinionated analysis of what this all means for the stock.
And, the transition happening inside this company right now is it's wild. We are not just looking at a successful software company anymore.
No, not at all.
We're looking at an entity that is fundamentally rewriting the economics of compute power. But to understand that strategy, I think we have to start with the baseline financial reality they just reported.
Let's lay out that baseline because the headline figures are, honestly, they're staggering. Q1 consolidated revenue hit $109.9 billion.
Wow.
Yeah, that is up 22% year over year, or 19% if we adjust for constant currency. And let me just pause right there. Wall Street analysts had modeled roughly a 12% growth rate.
So a massive beat.
A completely massive beat. They delivered 22%. From an analyst perspective, missing a forecast by a 10% delta on a $100 billion baseline, that means your financial models are fundamentally broken. The analysts completely misjudged the core velocity of the business.
Yeah, well, a top-line beat of that magnitude at this scale implies that the total addressable market actually expanded, much faster than anyone anticipated.
Right, because you can't just squeeze that out of nowhere.
Yeah. No, exactly. Right. You don't add almost $20 billion in new quarterly revenue just by raising prices a little bit or squeezing a bit more efficiency out of an existing ad network. You hit that number by capturing entirely new streams of capital.
But, top-line revenue is just a shadow on the wall if it costs you too much to acquire it, right? The number that signals the real operational story is the earnings per share, or EPS.
And that number was insane.
It absolutely skyrocketed, $5.11, which is an 82% increase year over year. Net income came in at $62.6 billion. So we are looking at a 22% increase in revenue, translating into an 82% increase in pure profit.
And that gap, that difference between 22% and 82%, that is the textbook definition of operational leverage.
Walk us through that, for a traditional business.
Sure. So in a traditional physical business, say like an airline or a grocery store, if you want to increase revenue by 20%, you usually have to increase your costs by, 18 or 19%.
Because you have to buy more planes or at least more shelf space.
Yeah, exactly. You need more physical assets and employees. But in highly scaled digital infrastructure, the cost to serve the next incremental user is essentially zero.
Right.
Once the data center is actually built and the AI model is trained, the marginal cost of a new search query or a new cloud customer drops precipitously. So when revenue grows at 22%, but the underlying fixed costs remain relatively flat, that extra revenue drops straight to the bottom line.
Which brings us to the segment where that leverage is probably the most obvious, and that's Google Cloud. This segment crossed a huge psychological and financial threshold, hitting $20 billion in revenue for the quarter.
That's a 63% jump year over year.
Yeah, 63%. But the real story isn't the $20 billion in revenue, right? It's the $6.6 billion in operating income. They literally tripled their operating income in a single year.
And to understand why that tripling is so significant, you have to look at the historical context of the cloud wars. For the better part of a decade, Google Cloud was viewed as kind of this wealthy but unprofitable third place player.
Right. Always trailing behind Amazon Web Services and Microsoft Azure.
Yeah. Alphabet was pouring billions of dollars into building out undersea cables, buying up real estate in Virginia and Ireland, outfitting server racks, all while taking losses on the actual segment.
They were just burning cash to build the network.
They were essentially subsidizing the cloud business with ad revenue just to buy a seat at the enterprise table.
And Wall Street absolutely hated it. I remember earnings calls 5 years ago where analysts were practically begging Alphabet to spin off the cloud division, or at least stop throwing good money after bad. The argument was AWS already won the scale game. Give it up.
Right, because cloud computing is a business defined by immense fixed costs. You have to lay the physical fiber optic cables and build the concrete cooling facilities, whether you have one enterprise client or 10,000.
Concrete costs the same either way.
Exactly. But the economics completely flip once you cross a certain threshold of network utilization. And Alphabet has now crossed that threshold. The fixed costs are absorbed.
So they've reached that critical mass.
Yes. From this point forward, when a new Fortune 500 company signs a $100 million contract to migrate to Google Cloud, almost the entirety of that contract after the basic electricity and maintenance becomes pure profit.
The utilization flip.
Yeah.
That makes so much sense. I mean, they went from a 17.8% operating margin in Q1 of last year to generating $6.6 billion in pure operating income this quarter. But it isn't just cloud carrying the weight here.
No, the core advertising engine is still a monster.
An absolute cash machine. Google Services, which encompasses search, YouTube, and the broader ad networks, brought in $89.6 billion.
Yeah.
Up 16%. And search alone generated $60.4 billion, which is a 19% increase.
The resilience of the search segment is perhaps the most critical data point for the long-term investor holding this stock. We need to dissect why that 19% growth occurred in a moment, but if we aggregate all these segments together, we arrive at the overarching profitability metric for the entire company.
Yeah, and that number is wild.
Alphabet posted an overall operating margin of 36.1%.
That 36.1% figure, it completely invalidates the old assumptions about physical infrastructure costs. Think about it. For every dollar Alphabet brings in, they're keeping roughly 36 cents in pure operating profit.
Right, and that's after paying for all the direct costs.
Exactly. After paying the engineering salaries, the real estate, the massive research budgets, maintaining a margin that high while acting as one of the world's largest physical hardware buyers is almost economically offensive.
It signals absolute pricing power. When a company can maintain a 36% margin, it means their customers have no viable alternative. They can dictate terms to the market. But, what management chose to do with all this excess cash is equally important.
The dividend.
Right. They declared a 5% increase in the quarterly dividend.
I look at that dividend hike, and the first thing I wonder is why a hyper-growth tech company, one that is aggressively reinvesting in AI, is bothering to pay a dividend at all. Historically, tech companies hoard cash to fund the next moonshot, right?
Yeah, that's the old Silicon Valley playbook.
Paying a dividend used to be the hallmark of a mature, slow-growing utility company that had just run out of ideas for how to use its capital.
That is the traditional view, but in modern corporate finance, a dividend from a mega-cap tech company serves a very specific signaling function. It's a legal recurring commitment.
Okay, so it's about confidence.
Absolutely. A CEO can go on CNBC and say they're confident in future cash flows, but talk is cheap, right? When the board of directors authorizes a dividend increase, they are legally binding the company to distribute a massive tranche of cash to shareholders every single quarter in perpetuity.
Oh, wow. So it's basically putting their money where their mouth is.
Exactly. It tells institutional investors, hey, we have stress tested our financial models. Even in our worst case scenario, accounting for all of our massive infrastructure spending, we will generate so much cash that we can afford to give you a raise.
And I imagine that changes who actually buys the stock.
It does. It anchors the stock price and reduces volatility by attracting income-focused funds that otherwise wouldn't buy a volatile tech stock.
So we've established this massive baseline. Record revenues, an 82% explosion in EPS, cloud tripling its operating income, margins expanding to 36.1%, and a confident dividend hike. But as an investor, a top-line number is just a snapshot of the past.
Right, you need to know where it's going.
Exactly. To know if this momentum is sustainable, we need to look under the hood. we need to understand the mechanical reality of what is actually generating this cash. The driver behind this quarter wasn't just a lucky break in the macroeconomic weather.
No, not at all. It was a deliberate, total reconstruction of their technology stack.
And that reconstruction revolves entirely around what management is calling the AI full stack payout. For years, AI was an abstract concept for investors, wasn't it? It was something discussed in research papers and long-term vision statements.
Yeah, it was a buzzword. But in this transcript, AI has officially materialized on the profit and loss statement.
Let me give you the specific data point that illustrates this materialization. Revenue from products built strictly on their generative AI models grew by nearly 800% year over year.
Which is just an unbelievable figure.
Yeah, that's a typo. 800%.
That is the inflection point where experimentation becomes actual monetization. But to understand why Alphabet is capturing this revenue and why their margins are actually expanding while doing it, we really have to break down their vertically optimized AI stack. This is the primary competitive moat of the company right now.
I see a lot of analysts use the term vertically integrated, but vertically optimized implies something a bit more active. Let's break down the mechanics of this stack for the listener.
Okay, the best way to visualize a vertically optimized stack is to think about a high-end farm-to-table restaurant empire.
Okay, I like this. Walk me through it.
Most restaurants, or in this case software companies, they just run the dining room. They buy their ingredients from a massive wholesale distributor, they hire independent chefs, and they focus purely on the customer experience. If the price of beef goes up at the wholesale level, the restaurant's profit margin immediately shrinks because they don't control the supply chain.
Got it. So in this analogy, the wholesale distributor is someone like NVIDIA selling the raw computing power, and the dining room is the software application that the consumer actually uses.
Precisely. Now, Alphabet didn't just build the dining room. They bought the farmland. They genetically engineered the seeds. They raised the cattle. They trained the master chefs in their own culinary schools. And they run the dining room.
They own the whole thing.
They own every single layer of production. So at the foundational level, the farmland Alphabet designs its own custom silicon. They are not entirely reliant on buying general-purpose GPUs from third parties.
Right, the TPUs.
Yes. They highlighted their 8th-generation tensor processing units on the call, the TPU-8T for training models, and the TPU-8i for inference. And they also utilize their custom Axion CPUs.
Let's explain the mechanical difference between a standard processor and a TPU, because I feel like this is where the cost savings actually occur. Why does designing a custom chip matter so much for the bottom line?
So a standard central processing unit, a CPU, is like a highly skilled general contractor. It can build a house, fix the plumbing, wire electrical systems, lay concrete.
It does a bit of everything.
Exactly. It is incredibly versatile, but because it has to be capable of doing everything, it doesn't do any one specific task with maximum efficiency. Now, generative AI doesn't need a general contractor. Generative AI relies on something called matrix multiplication.
Which is what exactly?
It's doing millions of very simple, repetitive mathematical calculations simultaneously. A TPU, a tensor processing unit, is entirely stripped of all that general-purpose versatility. It is essentially an assembly line worker whose only physical capability is stamping out matrix math at light speed.
Oh, wow. So it's hyper-specialized.
Exactly. And by stripping away the unnecessary architecture, the chip consumes vastly less power, generates way less heat, and executes AI calculations exponentially faster.
And the numbers back that up perfectly. Management stated the TPU-8T has 3 times the processing power of the previous generation, and the 8i delivers 80% better performance per dollar. That per dollar metric is the key, isn't it?
Oh, absolutely.
When you are serving billions of AI queries a day, a fraction of a cent saved on electricity and cooling per query translates into billions of dollars in operating profit at the end of the year.
That is the foundation. That's the farmland. The next layer up, the master chefs in our restaurant analogy, are the frontier models.
Right, the actual AI models themselves.
Alphabet discussed Gemini 3.1 Pro, which acts as the general intelligence layer for complex reasoning. But they are also deploying highly specialized, hyper-efficient models. For instance, they cited Lyria 3 for music generation, which has already created over 150 million songs.
Incredible.
They discussed Nano Banana 2 for image creation, which rendered 1 billion images in half the time of its predecessor. And they mentioned VO 3.1 Late for, cost-efficient video generation.
And we can't ignore Gemma 4, their open source model, which saw 50 million downloads in just a few weeks.
That's a huge adoption rate.
Right. By open sourcing the smaller models, they essentially train the next generation of global developers to build within the Alphabet ecosystem. But, okay, if the silicon is the farm, and the models are the chefs. What is the dining room experience that is driving this 800% revenue growth?
The dining room is what management refers to as agentic workflows.
Explain that, because it sounds like heavy corporate jargon.
It kind of is, but it's important. The industry has moved entirely beyond the concept of an AI chatbot. A chatbot requires a human to prompt it, evaluate the answer, and then take action. An agentic workflow means the AI acts as an autonomous digital worker.
It does the work for you.
Right. Alphabet revealed an internal initiative called Anti-Gravity, where they are using orchestrated teams of AI agents to autonomously write code, test software, and even manage server infrastructure.
They are essentially using their own AI to build the company faster, replacing manual engineering hours with compute cycles.
Which saves them a fortune.
Exactly. And then they are packaging that exact same capability and selling it to their enterprise cloud customers.
Which is a brilliant monetization strategy, frankly. You prove the ROI internally, you document the efficiency gains, and then you turn around and sell the software to other Fortune 500 companies desperate to cut their own labor costs.
It really is. But I want to pivot back to the consumer side of this AI integration, because there is a massive contradiction here we really have to address. For the last 3 years, the prevailing thesis on Wall Street was that AI was an existential threat to traditional Google search.
Oh, people were terrified.
And the argument was incredibly logical. If I could just ask an AI a question and get one single perfect synthesized answer, why would I ever scroll through a page of blue links?
You wouldn't.
Right.
Yeah.
But more importantly, if I don't scroll through the links, I don't click on the targeted ads that generate the vast majority of Alphabet's revenue. So if AI is supposedly destroying the traditional search model, why on earth is search revenue up 19% to over $60 billion?
It is the ultimate contrarian outcome, and honestly, it proves that human behavioral psychology is often more complex than Wall Street models assume. The earnings call addressed this directly. Search queries are not down, they are at an all-time high.
Wait, all-time high?
Yes. The integration of AI didn't cannibalize the search habit, it deepened it.
Walk me through the mechanics of that. How does an AI answer generate more searches?
So Alphabet embedded AI directly into the results page with AI overviews and a dedicated AI mode. What their data scientists discovered is that when you remove the friction of having to dig through 20 different websites to piece together a complex answer, users don't just stop searching.
What do?
They start asking harder, longer, and much more complex questions. I mean, think about it. Before AI, you wouldn't ask a search engine, plan a 5-day itinerary for a family of 4 in Tokyo, focusing on historical sites with a daily budget of $200.
Because it would just give you disjointed travel blogs. It would take hours of manual research to put that together.
Exactly. But now, the AI parses that complex intent immediately. Because the tool is vastly more capable, users are relying on it for more high-value, complex tasks throughout their entire day.
The pie got bigger because the utility of the tool expanded. That makes a ton of sense. But there is a second half to this equation that Wall Street was terrified of, and that's the compute cost.
Ah, yes. The inference cost.
Right. Generating a custom AI overview for every single query is computationally massive compared to just returning an index of cached links. Even if usage went up, the fear was that the electricity and server costs required to run inference on all those complex queries would obliterate their profit margins.
Which brings us right back to the farm-to-table optimized stack. If Alphabet had to buy off-the-shelf GPUs and pay a third party to run those models, their margins likely would have collapsed.
They'd be paying retail prices for wholesale queries.
Precisely. But because they designed the TPUs and engineered the Gemini models to run specifically on that silicon, they have absolute control over the inference cost. The CFO explicitly stated that they reduced the cost of core AI responses by more than 30% through hardware and engineering breakthroughs just in the last 12 months.
A 30% reduction is huge at that scale.
And furthermore, they reduced search latency, the time it takes for the page to load, by over 35% over the past 5 years, even while adding all these heavy AI features.
So let's expand on why latency matters, because a 35% reduction in page load speed sounds like, a nice user experience tweak, but it's actually a massive financial lever.
Oh, it's everything in e-commerce.
Right. In e-commerce and search, milliseconds dictate abandonment rates. If a page takes half a second longer to load, a measurable percentage of users will just click away, meaning the ad impression never loads and the revenue is lost.
Yeah, people are incredibly impatient.
Exactly. By speeding up the AI inference through TPU optimization, they're simultaneously saving literal megawatts of power across billions of queries and ensuring the user stays locked into the ecosystem long enough to see the ads.
And the ads themselves are being entirely overhauled by the AI. They are not just placing static text blocks anymore. They are deploying Gemini across the entire ad infrastructure.
How does it look in practice?
Well, for example, they discussed improving ad relevance by nearly 10% in Google Maps by using Gemini to contextualize a user's surroundings and immediate intent. And they also rolled out a tool called AI Max for advertisers. They highlighted a case study where Hilton hotels used the AI to optimize their ad placements and creative copy, resulting in a 33% increase in clicks for a 20% reduction in ad spend.
Wow. When you can show an advertiser that your AI can get them a third more customers for a fifth of the cost, you lock in that advertising budget forever. They're never leaving.
Never.
But, there was another development discussed on this call that goes far beyond traditional advertising. This was buried in the middle of the transcript, but I really think it might be the most revolutionary consumer-facing item they discussed. I'm talking about the Universal Commerce Protocol, or UCP.
Yes, the UCP Tech Council. This is a profound shift in how commerce operates on the internet, and Alphabet is positioning itself at the absolute center of it.
Who else is involved in this?
The council includes giants like Amazon, Meta, Microsoft, Stripe, Shopify, Etsy, and Target. They are collaborating to build an open source standard for agentic commerce.
Let's break down a real-world scenario of agentic commerce for the listener, because this fundamentally threatens the entire existing structure of online retail.
It really does.
Right now, the internet is highly fragmented. If I want to buy, say, a home theater system, I search for reviews, I click an ad, I get routed to Best Buy or Amazon's website, I create an account, I put the items in a cart, I pull out my credit card, I enter my shipping details, and I check out.
It's a lot of friction.
It is. That requires navigating through multiple different corporate interfaces. How does UCP actually change that?
So UCP, combined with Alphabet's AI mode, collapses that entire fragmented journey into a single continuous dialog box. Imagine you tell the AI, I want to upgrade my living room to a 7.1 surround sound system. My budget is $1,500, my room is 15 by 20 feet, and I prefer Sony components.
Okay.
The AI analyzes the acoustic requirements of your room size, cross-references inventory across Best Buy, Amazon, and specialized audio retailers, negotiates the best price, ensures all the cables are compatible, and presents you with the final package.
And here's the critical part. I don't then click a link to go to Best Buy's website, do I?
Exactly. You never leave the search interface. Because UCP is a standardized protocol, the AI acts as your authorized purchasing agent. It securely transmits your payment details and shipping address directly to the retailer's backend systems via API. You simply say, purchase this, and the AI executes the transaction across multiple retailers seamlessly.
If I'm Shopify, I am terrified of this. I mean, Shopify built a massive business, providing the back-end infrastructure and the sleek storefronts for independent retailers to sell direct to consumers.
Right.
But if the consumer's no longer visiting the storefront, if they are just having their AI talk to the retailer's AI to execute the purchase, the storefront becomes irrelevant.
It completely commoditizes the storefront. The interface is no longer the website. The interface is the Alphabet search bar.
That's insane.
And by spearheading the UCP standard, Alphabet ensures they act as the primary toll booth for this new era of commerce. Even if they don't charge a direct transaction fee, they control the discovery phase. Retailers will have to bid massively on agented ad placements to ensure the AI recommends their products over a competitor's during that automated negotiation.
It is an incredibly sticky ecosystem. And speaking of keeping users locked in, let's look at the subscription metrics they reported. Alphabet announced 350 million paid subscriptions across their various platforms.
Which is largely driven by YouTube Premium and Google One cloud storage.
Right. 350 million recurring credit card charges. That provides a baseline of highly predictable, highly stable revenue that insulates the company from the cyclical volatility of the digital advertising market.
Yeah, ads go up and down with the economy.
Exactly. During an economic downturn, a corporation might slash its ad budget overnight, but consumers rarely cancel their core digital utility subscriptions. They might cancel cable, but they're not canceling the extra storage for their family photos.
And they are successfully layering premium enterprise AI right on top of that baseline. They noted that Gemini Enterprise paid monthly active users grew by 40% quarter over quarter.
40% in one quarter.
Yes. They have global legacy brands, companies like Bosch, Merck, and Mars, incorporated buying enterprise-grade AI licenses for their entire workforces.
Which illustrates the brilliance of their dual-pronged monetization strategy. Alphabet is maintaining the ubiquity of their free ecosystem search, standard YouTube, basic Gmail, which keeps billions of users tethered to their services. But for the power users and the massive corporations, they are seamlessly upselling advanced AI capabilities.
Right, they don't have to spend billions on marketing to acquire new customers.
Exactly. They don't need a massive sales team. They simply place an upgrade button inside the Gmail interface that 2 billion people already use every single day. That 40% sequential growth is the direct result of zero friction distribution.
So, if we step back and look at the story behind these Q1 numbers, the vertically optimized stack is dropping the cost of compute by 30%. The models are driving an 800% increase in Gen AI product revenue. Search is expanding, not contracting, because AI overviews encourage complex queries.
Yeah, the UCP is building the infrastructure for autonomous agentic commerce.
Right, and they have 350 million people paying them a monthly fee. It is an airtight operational narrative.
It is flawless execution of a present-day strategy. However, the stock market does not value a company based on what it did over the last 90 days, right?
No, the market is a forward-looking discounting mechanism.
Exactly. It is constantly trying to price in the future reality. And that requires us to pivot our analysis entirely toward the guidance management provided.
Let's talk about that guidance, because while the operational narrative is airtight, the financial projections for the future require us to confront the elephant in the room.
The CapEx.
The absolute staggering scale of their capital expenditures. I mean, you mentioned at the start of the deep dive that Alphabet spent $35.7 billion on CapEx in Q1 alone.
Right.
Management stated that the overwhelming majority of this capital was deployed into technical infrastructure. Roughly 60% went directly to buying servers and compute hardware, and the remaining 40% went to the physical reality of data centers. The land, the concrete, the networking gear, and the cooling systems.
But the bombshell came when they provided the full-year forecast. They raised the 2026 CapEx guidance to a range between $180 billion and $190 billion. And the CFO explicitly warned that 2027 will significantly increase from there.
We are witnessing the most aggressive, concentrated deployment of private capital into physical infrastructure in modern economic history. You honestly have to look back to the construction of the transcontinental railroads or the early rollout of the global telecommunications grid to find a parallel for this level of sustained, singular investment.
Let's visualize what $190 billion in physical infrastructure actually looks like, because numbers that large just lose their meaning to a normal person. We aren't just talking about buying a few extra hard drives here.
No, not at all. Building data centers at this scale requires fundamentally altering local economies and regional power grids. Before you even pour the concrete, you have to secure the land, which often involves navigating years of municipal zoning laws.
It's a massive physical footprint.
And the biggest bottleneck isn't even land, it's electricity. A modern AI data center consumes as much power as a mid-sized city. Alphabet is having to negotiate massive multi-year power purchase agreements directly with utility companies.
They're literally becoming power players.
They are funding the development of new solar farms, wind arrays, and in some cases, exploring advanced geothermal and nuclear options just to guarantee they have the base load power required to turn the servers on. And that's just the power. You have the global supply chain logistics of sourcing the rare earth metals for the chips, the advanced cooling systems to prevent the hardware from melting, and the thousands of specialized technicians required to physically rack and maintain the servers.
Okay, I am going to push back hard here because this is where the skeptical investor has to ask the tough questions. If they are committing nearly $200 billion a year to depreciating physical assets, how is this not a massive existential risk to the company's valuation?
It is a massive risk.
When you buy a server, you don't expense it all at once. It sits on the balance sheet and depreciates over 4 to 6 years. That depreciation acts as a massive anchor dragging down the profit and loss statement.
That is the central tension of the Alphabet investment thesis right now.
Exactly. What if the macroeconomic environment shifts? What as inflation spikes again, interest rates stay elevated, and all these Fortune 500 companies decide they need to cut their IT budgets? What if the venture capital funding dries up and the thousands of AI startups currently renting compute power from Google Cloud suddenly go bankrupt?
Right, the bubble bursts.
Yeah. Alphabet would be left holding the bag on hundreds of billions of dollars of rapidly depreciating hardware, sitting in empty data centers, generating zero revenue, but still incurring massive electricity and maintenance costs. The margins would collapse overnight.
Your hypothetical is entirely valid. It is the nightmare scenario for any capital-intensive business. You overbuild ahead of demand, the demand evaporates, and the fixed costs drown you. However, management is well aware of this risk, and they provided a specific, quantifiable metric to justify the spend. They are not building these data centers on speculation. They are building them against a metric called the Google Cloud backlog.
Let's dissect the backlog.
Yeah.
In corporate accounting, what exactly qualifies as a backlog? Because it's not just a guess, right?
No, a backlog is not a projection. It is not a pipeline of potential sales leads. A backlog represents the total legally binding value of non-cancelable contracts that enterprise customers have already signed.
Just locked in.
The customer has committed to paying the money, but Alphabet cannot recognize it as revenue yet because they have not yet delivered the compute service. It is essentially guaranteed future revenue locked in by corporate attorneys.
And the number they dropped for the cloud backlog was $462 billion. Let me repeat that for everyone. $462 billion in signed, non-cancelable contracts. And they noted that this number nearly doubled sequentially from the previous quarter.
That $462 billion is the insurance policy against the macroeconomic nightmare scenario you just outlined. Yes, they are taking on massive depreciation risk with a $190 billion capex build-out, but they have already secured almost $500 billion in guaranteed revenue to offset it.
It is the equivalent of a real estate developer pre-selling every single unit in a skyscraper before they even dig the foundation.
That's a perfect analogy, and management explicitly stated they expect to recognize just over 50% of that $462 billion backlog as top-line revenue over the next 24 months.
So they have clear contractual line of sight to the cash flow that will pay the mortgage on these data centers. The demand isn't theoretical. It is already sitting on the balance sheet waiting to be fulfilled.
The CEO made a fascinating comment during the Q&A portion of the call that highlights this exact dynamic. He noted that Google Cloud's Q1 revenue would have actually been significantly higher if they hadn't been completely compute constrained.
Wait, meaning what?
They literally could not physically rack the servers fast enough to satisfy the demand of the clients who wanted to pay them.
Oh, wow. So they're leaving money on the table because they can't build fast enough.
Exactly. When a business is in that specific position where customer demand vastly exceeds supply and the return on invested capital remains historically high, the most rational fiduciary action management can take is to deploy every available dollar into expanding capacity. To not spend the $190 billion would be an abdication of their responsibility to capture the market.
That significantly de-risks the CapEx narrative. But, management did not just paint a universally rosy picture of the future. A crucial part of reading an earnings transcript is translating the subtle warnings executives dropped to manage Wall Street's expectations.
And there were two specific headwinds mentioned in the guidance that we really need to unpack.
Right. First, let's talk about the integration of the Wiz acquisition.
So in March of this year, Alphabet finalized the acquisition of Wiz, which is a highly regarded cloud and AI security platform. The strategic rationale is sound. Alphabet is integrating Wiz's technology directly into Google Cloud to offer what they term agentic defense.
I assume agentic defense is the security equivalent of the autonomous digital workers we discussed earlier.
Exactly. Instead of human security analysts staring at dashboards waiting for an alert, agentic defense deploys autonomous AI agents that actively hunt through a client's network architecture, identify vulnerabilities in real time, and automatically write and deploy patches before a breach can even occur.
Which is necessary because the hackers are using AI too, right?
Yes. In a world where cyber attacks are increasingly automated by malicious AI, defending networks with human reaction times is just no longer viable. You have to fight AI with AI. So strategically, the acquisition makes perfect sense and strengthens the cloud value proposition.
But strategically sound doesn't always mean financially painless in the short term. What is the warning management actually issued regarding Wiz?
The CFO warned that the Wiz acquisition will create a low single-digit percentage point headwind to cloud's operating margin for the remainder of 2026.
Let's explain the mechanics of that drag for the listener. Why does buying a profitable, growing company temporarily hurt Alphabet's margins?
When you acquire a massive enterprise like Wiz, you don't just acquire their technology, you absorb their entire cost structure overnight. You take on their engineering headcount, their real estate leases, their marketing budgets, and their administrative overhead.
And startups operate differently than Alphabet.
Completely. Wiz was operating as a fast-growing private startup, meaning they were likely burning cash or operating at lower margins to prioritize growth over profitability. Alphabet now has to absorb those lower margins into its own pristine 36% margin profile.
And there's the actual cost of merging the two companies.
Right. There are massive immediate costs associated with integrating the two companies, migrating data systems, consolidating sales teams, paying severance or retention bonuses. And from an accounting perspective, Alphabet has to begin amortizing the intangible assets and goodwill generated by the purchase price. All of this acts as an immediate heavy anchor on operating profit.
So the translation for the retail investor is crucial here. If you look at the Q3 or Q4 earnings reports later this year and see that Google Cloud's operating margin has dipped from, say, 33% down to 30%, you should not panic.
No, it's totally expected.
You should not assume the core cloud business is losing momentum. Management has aggressively telegraphed this exact scenario. It is a temporary, expected accounting reality of digesting a massive acquisition, not a fundamental flaw in the business model.
Precisely. It will take 12 to 18 months for Alphabet to rationalize Wiz's cost structure, eliminate the redundancies, and bring those operations up to their internal efficiency standards.
The second warning was heavily macroeconomic. Management stated they expect a 1.5 percentage point foreign exchange headwind in Q2. Let's break down the mechanics of foreign exchange, or FX, because it constantly distorts how global companies report their growth.
It really does. So Alphabet is a global entity, but their stock is priced in US dollars, and their financial statements are reported in US dollars. When they sell a cloud contract in Germany, they are paid in euros. When they sell ads in Japan, they are paid in yen. At the end of the quarter, all of those foreign currencies must be translated back into US dollars for the earnings report.
And those rates are always moving.
Exactly. The exchange rates between these currencies fluctuate daily based on global interest rates, inflation, and geopolitical events.
So the value of the revenue changes based purely on the currency markets, regardless of how many ads they actually sold.
Correct. In Q1, Alphabet actually benefited from a 3% FX tailwind. The US dollar was relatively weak against certain key currencies during that period, meaning those euros and yen translated into more US dollars artificially boosting the reported revenue growth.
But now the tide is turning.
Yes. The currency markets have shifted. The Federal Reserve's recent actions have strengthened the US dollar. A strong dollar is terrible for multinational earnings because foreign currencies now buy fewer dollars. So management is warning that in Q2, the reported revenue growth might look 1.5% lower than the actual operational growth of the business, purely due to the math of currency conversion.
Which again is a macroeconomic reality, not an operational failure of Alphabet sales teams. It's vital context. If growth comes in at 18% next quarter instead of 19.5%, you know the delta is driven by the currency markets, not a slowdown in product adoption.
Exactly. Don't let the headlines scare you.
Now I want to move to the final piece of guidance. We've talked about the CapEx, the backlog, and the short-term headwinds.
Yeah.
But buried in the Q&A session with the analysts was a strategic revelation that completely alters the long-term trajectory of the company.
Oh, this was the biggest news of the call.
It really was. It is a development that bridges the gap between software, cloud infrastructure, and hardcore physical manufacturing. Alphabet confirmed that they are no longer just using their custom TPU hardware internally. They're beginning to sell the physical TPUs directly to select enterprise customers for deployment in on-premise data centers.
This is a seismic shift in their business model and a direct challenge to the fundamental architecture of the tech industry. To understand the gravity of this, you have to look at how the cloud ecosystem has operated for the last decade.
Okay, set the stage for us.
Historically, the entire value proposition of Google Cloud or AWS or Azure was the walled garden. If a massive financial institution or a frontier AI research lab wanted access to the immense computing power of Alphabet's custom TPUs, they had only one option. They had to rent them by the hour through the Google Cloud interface.
They couldn't take them home.
Right. They had to move their data into Alphabet's physical data centers and play by Alphabet's rules. Alphabet maintained absolute control over the physical asset.
They rented the compute, but they never sold the silicon.
Exactly, but there is a subset of the global economy, massive capital markets firms, sovereign wealth funds, highly classified defense contractors, and certain frontier AI labs that legally or strategically cannot move their proprietary data into a public cloud environment.
Because it's too sensitive.
They demand what is called on-premise compute. They want the servers physically located in their own secure basements, disconnected from the public internet. Historically, Alphabet missed out on that revenue entirely. Those clients would simply call NVIDIA, buy tens of thousands of GPUs, and build their own local clusters.
But now Alphabet wants a piece of that pie.
Yes. By boxing up the TPU 8T and selling it directly as enterprise hardware, Alphabet is unlocking a massive new addressable market.
From a strategic standpoint, they are evolving from a software and services company into an arms dealer. The AI revolution is the war, and Alphabet has decided they aren't just going to fight in it. They're going to manufacture and sell the heavy munitions directly to other armies.
The arms dealer analogy is apt, and management noted an important accounting detail regarding this shift. A small percentage of this new hardware revenue will begin hitting the P&L in the back half of 2026. But the vast majority of the impact will be recognized in 2027 as manufacturing scales up.
So it's not priced in yet.
No, this introduces an entirely new high-margin revenue stream, enterprise-grade silicon sales that analysts have not fully modeled into the stock price.
Which brings us to the culmination of this deep dive. We have meticulously reviewed the past performance, the $110 billion top line, the 82% EPS explosion, and the 36.1% operating margin.
Huge numbers.
We have dissected the present drivers, the vertically optimized farm-to-table stack, the 30% reduction in compute costs, the 800% growth in Gen AI products, and the UCP agentic commerce revolution.
The whole playbook.
And we have analyzed the future guidance, the $190 billion CapEx build-out, completely de-risked by a $462 billion contract backlog, the Wiz integration, and this massive pivot to hardware sales. Now, our mandate on Talk Tickers is to never just present the data in a vacuum. We distill all of this complexity into a final actionable verdict for you, the retail investor, trying to decide what to do with your portfolio.
And well, the data presents a very clear empirical narrative. The primary fear surrounding Alphabet and the broader mega-cap tech sector over the last 2 years was the capital destruction hypothesis.
The AI would just burn all their cash.
Right. The fear was that the transition to generative AI would be a Pyrrhic victory. Companies would have to spend hundreds of billions of dollars to build the infrastructure, the compute costs would destroy their gross margins, and the AI tools would ultimately cannibalize their highly profitable legacy search businesses.
And based on the Q1 2026 data, my verdict is that Alphabet has comprehensively dismantled that hypothesis. If you are a listener holding this stock, or if you are considering initiating a position, this earnings call is an unequivocally bullish signal. They prove that the AI monetization loop is not theoretical. It is fully operational and generating cash at a historic rate.
The mechanics of that loop are the core of the bullish thesis here. I mean, they deploy massive capital to build the infrastructure. That infrastructure allows them to train more capable AI models. Those models are then deployed to make the core search engine more useful, which drives query volume to all-time highs.
It feeds itself.
Simultaneously, they optimize the custom silicon to drop the inference cost by 30%, widening the profit margin on every search. They then package that same technology and sell it to enterprise cloud customers, tripling operating income.
And then they just keep spinning it.
And finally, all of this activity generates so much free cash flow that they can simultaneously raise the dividend by 5% and fund next year's $190 billion infrastructure expansion without taking on crippling debt. The flywheel is spinning with immense velocity.
They successfully navigated the most dangerous technological transition in a generation, the shift from the blue link search era to the generative AI era, and they emerged with better margins and faster growth than they had before. The $462 billion backlog acts as a massive concrete floor under the valuation, effectively guaranteeing the revenue required to sustain the expansion over the next 24 months.
However, while the immediate financial reality is highly secure, the shift in their long-term strategy introduces a new variable that investors must monitor closely. If we look past the next few quarters and connect the data points to the broader macroeconomic picture, the most provocative revelation in this transcript is the decision to sell the TPU hardware directly to customers.
The pivot to becoming an arms dealer.
Yes, but in the global market for AI silicon, there is already an established dominant arms dealer.
NVIDIA.
NVIDIA. For the past decade, Alphabet and NVIDIA have existed in a symbiotic, mutually beneficial partnership. Alphabet is one of NVIDIA's largest customers, buying billions of dollars worth of GPUs to stock the Google Cloud and train their models, and NVIDIA relies on Alphabet's scale to drive their own revenue.
But symbiosis only lasts as long as the strategic goals are aligned. By packaging their proprietary TPUs and actively selling them to external enterprise customers, the exact same sovereign wealth funds and frontier labs that NVIDIA targets Alphabet is quietly stepping out of the software arena and directly onto NVIDIA's turf.
It raises a profound question for the future of the industry. Can you remain vital partners while simultaneously becoming direct competitors in the most lucrative hardware market on Earth? By commoditizing their own silicon, Alphabet is attempting to capture the physical infrastructure layer of the AI economy. Are we watching the early, quiet stages of the cloud wars evolving into a brutal zero-sum hardware war for absolute supremacy over the future of compute?
That is the multi-trillion-dollar question that will define the tech sector for the next decade. A quiet war between the sovereign king of software and the undisputed king of silicon. It is a dynamic we will be tracking relentlessly as the 2026 fiscal year unfolds.
It's going to be fascinating to watch.
Thank you for joining us for this extensive Talk Tickers deep dive into Alphabet's Q1 reality. Our goal is always to cut through the corporate noise, explain the mechanical reality behind the jargon, and give you the clear, data-driven perspective you need to navigate the markets. Remember, the narrative on Wall Street changes daily, but the math rarely lies. Keep your eyes firmly on the numbers, question the consensus, and stay insanely curious. Until next time.